Sometimes our transactions are much more complex. Hopefully each of you have dealt with this type of problem. Here we want to assume that you invest in an apartment complex for $275,000. The interest rate, or cost of capital as I like to call it, is 13%. This is where you could invest that money otherwise, or the cost of borrowing that money to invest. The depreciable life is 27.5 for this problem, very convenient being as that divides into the purchase price very well. Marginal income tax rate is 28%. The annual rental income is $75,000 per year, but operating costs are 35% of that. Future sales we hope to be able to sell it for in 5 years is $400,000. But there's some costs to selling, including commissions and closing fees of 10%. We want to know what the net present value and the internal rate of return will be for this real estate investment. Hopefully in the past you've created a table similar to this, where during the years 1 through 5 we put in the rental income, less operating expenses, that's the 35% of the rental income, and this is before tax cash flows. Next, we take depreciation. Straight line would give us $10,000 per year, and so we subtract that from our before tax cash flows to get a taxable income of $38,750. Applying our tax rate to that, we will pay taxes and be left with $27,900 after-tax net income. Why do we add back that $10,000 depreciation to get after-tax cash flows? That's right. Many people don't understand that depreciation is not a cash flow. It's just something that allows us to pay less taxes and to show more the correct value, although the value argument is questionable. So we've taken those cash flows for all 5 years. Here's our initial purchase price. And finally, we have this settlement when we actually sell the property. Take a moment and see if you understand what the formula is saying here. You've been given this worksheet, but you need to understand and agree with each of the formulas on it in order to take advantage of it. Let me help you. What does this first part say? B16 times 1 minus B17. That's right. That's the net cash you receive from the sale. That is the sale minus any commission or closing costs. Next, we're going to see how much tax we have to pay here and subtract that out. B9 is our tax rate. So what have we got here? First of all, notice this first part is exactly the same. It's the amount that we've cleared from the sale of the property. We take out B4. What is B4? It's the purchase price. We don't have to pay tax on that portion of the profit. And then we minus C24 through G24. Well, 24 is our depreciation rates. So we're summing those up. We call this recapturing depreciation. We do have to pay taxes on depreciation at the end or the sale of the property. Why am I subtracting it? Because these amounts happen to be negative here in this table. So that is the net cash from the sale minus the purchase price, and then adding back in any depreciation we've taken, and we'll pay taxes on that. So that net sale minus any of the taxes is shown here after tax cash from the sale, and gives us a total down here of $360,100 for year 5. Okay, now let's go take the net present value. There are 2 ways to do that. I can take the net present value times the rate minus each of the values and then add on the value in period 0. Or I can take the rate and all the values times 1 minus the rate. Go ahead and figure the first one. Okay, let's try this together. So equals net present value, and it wants the rate. Where do I find the rate? That's up here. It's our cost of capital, or the required rate of return. And you might be able to see this better up here, comma, and then all my values. And then it says at the end, add back in value 0. That is the initial cost here. And it shows that we have a net present value of $33,180. Or remember how to turn that into dollars and cents. Control, Shift, $, and we have $33,180 and 32 cents. Now try the next net present value method. Okay, let's do it together. So equals net present value, and it wants the interest rate, or investor's cost of capital, and comma. You might be able to see it better up here. It wants all of the cash flows from period 0 through period 5. And then we adjust it times 1 plus, again, that cost of capital. Why do we do that? That's right, we need to move everything back one period. So it shifts everything back one period, and when we put that in, we're going to get exactly the same net present value. So either method works, but we need to remember to make that adjustment. When we see 33,000, is that a good value? How do we know? What it means is that we've covered our cost of capital, and in addition, we've earned $33,180.32. So yes, that is very positive. Let's do the internal rate of return and find out what we're really earning on this. Go ahead and try that. Okay, let's do this together. And it says take all of the values, all of our cash flows, and then it's asking for a guess. Now we could put anything in here. Notice if I click up on here, when I click on guess, it says is a number that you guess is close to the results, or if not, if omitted, they're going to stick in 0.1 or 10%. That's fine. We can let them just do that, or we can just, I often will just put in 1. Any number will do, and then it calculates down. When you see a formula with a guess like that, you know that it's a hill climbing algorithm, that it's going to keep putting in new values until it reaches a stable amount. It looks like our internal rate of return is 16.26%. Again, that is higher than our cost of capital of 13%.